So it's a pleasure to have this session with Rafael da Mata and Caio Almeida. It's the special session on finance, so it's worth a prize, a big prize. And we are going to start with Rafael. He's going to talk with the stock manipulation, distort corporate investment, the role of short selling costs and share repurchase, and it's a joint paper with Murilo Campillo and Pedro Safi. So the schedule says you have half an hour and Caio has 1 hour, but I guess that's not really fair. So let's do 45 minutes each, including questions. If anyone has a question, please let me know through the chat. And if we have the opportunity, we can obviously take the question during the presentation. Okay, so without further ado, let me give the floor to Rafael. Please, you have 45 minutes.
Okay, so thanks very much, Marcelo. It's a pleasure to be here. As you said, this is a joint work with Murilo Campillo, who was one of my advisors, the PhD program, and with Pedro Safi, who's a colleague and a co-author now. So just to start here, so what we want to do in this paper here is essentially to ask the question of how does stock manipulation distort investment in the presence of short selling costs, and when managers they can repurchase stock. So I'll start with some motivation here. So you know that one the main function of primary markets essentially is to provide capital to firms. So investors provide capital to firms, for instance, through debt IPOs and equity IPOs. And we also know that there's some problems in these markets, okay, because there's some asymmetric information between the capital providers and the firms. So that you have adverse selection, have more hazard, and these kind of limits the amount of funds the firms can borrow in order to invest. It limits their debt capacity, okay? So this is something well known, is people know that this is important, but the other question we want to focus on here is that do secondary markets, they also matter for capital allocation? Okay, so does it help? I mean, do prices kind of aggregate information to facilitate and to increase the efficiency of the allocation of resources? And so you know that this literature, there's a literature for this started a long time ago with Hayek, saying that yes, prices do convey information because they aggregate information. So it's important for capital allocation, for the efficiency of capital allocation. However, there's some recent studies showing that there's also a limit to how much prices can convey information. Okay, so there's this important paper here by Goldstein-Gumbel that was published at the Restud. It's also one of the main references of our paper here. And they show that actually the short selling manipulation, okay, so manipulation of prices by short sellers can actually limit the efficiency of informativeness, okay? So for instance, the idea is that if you're a short seller and you know that managers, they learn from stock prices also about the fundamentals of their own firm. So it kind of, they helps them decide whether they should invest or not. So if they establish a short position and they keep pushing the price of the firm down, so probably the manager would think, wow, there's something wrong with my firm. It's worse than I thought. So they might actually reduce investment, which would be kind of value enhancing. So the value of the firm reduces. So kind of they can actually essentially then close their position at a profit, because kind of a self-fulfilling thing. So in this context, then you might ask, people might wonder where the short selling costs. Okay, so when speculators, they face some short selling costs in order to short sell firm, and actually have some important impact, okay, on price efficiency and investment decisions by firm. And also, you can also think that, well, managers, if they know there's some manipulation, okay, they can kind of like anticipate all of that and perhaps get together with capital providers to establish contracts that perhaps can fight this manipulation, for instance, through allowing firms to do stock repurchases. So what we do in this paper here is to provide a fully fledged analysis of the impact of shorting cost on manipulative trading and corporate policies when firms can repurchase stock, okay? So our analysis here integrates several key features of the real world, okay, of the market for stock, because short selling cost is something actually very real. We have a specialist in the audience on this, and then you know that if you want to short sell a stock, you need to borrow stock. So if you want to borrow stock, nobody's actually going to lend it to you for free. So you need to pay a fee for that. And there's many frictions that actually affect the price of this fee, such as the ability that you have to find people that are willing to lend the fee. So it's like a search cost. And there's also a matching cost, because not only you need to find someone willing to lend stocks, but you also need to find someone willing to lend the stock you want to short sell. So there are many frictions regarding this, okay? So which affect the cost of short selling. So also our contract to kind of like accommodates or also allows for some financing instruments that reflect many financing instruments in the real world, okay? Especially state contingent stage funding, such as credit lines, for instance, that can be revoked after you observe negative signals. After credits observe negative signals about the firm, they can revoke credit lines. This is very common. IPOs combined with warrants, so that people can convert these warrants into equity later on, and also convertible debt. Okay, so people that can convert, the investors can convert the debt into equity. So all of these are kind of state contingent stage financing. So you have multiple rounds of financing, and they're all state contingent. It depends on the behavior of the stock price. So our analysis kind of also accommodates all of these financing possibilities, and it also has practical implications. Okay, because as we're going to show, the factor of shorting cost of investment it varies across many dimensions. So it's also relevant for empirical research, to know what kind of relevant variables to include in the regressions, and also for regulators if they want to actually adopt regulations that change the cost of short selling. And how we do it, okay? So our model advances the same work on feedback effects by Goldstein-Gambo by including the possibility that speculators, they're subject to shorting costs. Okay, so we model, our shorting costs it's exogenous costs, which are caused by market frictions, search and matching costs. Also, we kind of make the model a bit more dynamic. So Goldstein-Gambo's model is just a one-shot game. Okay, so you have multiple rounds of trading, but it's just a one-shot game in terms of investment. So here we make the model more dynamic to allow for the possibility that managers and creditors can meet ex ante, contract on make contracts contingent on future prices and make future repayments contingent on price performance as well. And then you also let you have a refinancing reinvestment after the market kind of reviews information to creditors. Okay, so we make it more dynamic and to see how contracting can affect all of that. So we show that, and then the feedback effects in our model also different from the Goldstein-Gambo's model, because their paper suffered a lot of criticism because it's about the manager learning about the manager's own firm. So like Jeff Bezos learning about Amazon from stock markets, which kind of strange, right? So our model is a little bit more realistic in the sense that here the managers know at least as much as speculators, but they need to borrow from capital providers that know less about the firm, and capital providers they learn about the situation of the firm. Okay, so this is something that we add, and it also allows us to investigate the agency problem in this case, because capital providers they don't observe all the actions taken by the manager. So this is asymmetric information there, and also managers they might have private benefits from making some investment decisions. So there's an agency problem here, such that the capital providers that can design contracts to kind of mitigate these agency problems. Okay, so the type of contract that helps mitigate these problems are state contingent financing, and these because financing state contingent provides managers with incentives to do repurchases to affect the stock price and to try to do the right thing. Okay, so that's the idea. And our contract is split into two setups. Okay, so first we focus on the model when you don't allow for ex ante contracting, in the sense that the manager and the capital providers cannot write a contract that makes future refinancing or future reinvestment contingent stock prices. So which means that in this case, the investors just provide the funding to the firm. And then the firm, if in case of refinancing needs, it needs to go back on the spot market to borrow more money from investors. So this would be essentially kind of to try to speak directly to Goldstein-Gambo's paper. And then we had another setup where the parties can get together, write contracts to make future refinancing and reinvestment contingent on stock price. And what we find, okay, so those are going to give you preview results. There's a theory paper, and I won't be able to get into the very details of the theory, so I want to provide some of the early results here. So we find that first, when we look at the effect of rising short selling costs, when we don't allow for ex-ante contracting. Okay? So what we find is that if you raise costs, okay, if you raise costs, then the effect is positive on investment at moderate levels of short selling costs. And at high levels of short selling costs, the effect is negative. Okay. However, at low shorting cost, okay, even though if you increase short selling cost, it curbs manipulation, okay, it comes at a cost. It also hinders informed trading, essentially informed short selling. So if short selling costs are low, if you start increasing short selling costs, it is true that actually curbs manipulation, but it comes at a cost of also reducing informed trading. So the effect in the end is going to be negative. Speculators are likely to possess information that's relevant to capital providers. And it's going to be positive if speculators are likely uninformed or unlikely to be informed. And this is something critical here because it kind of one of the main contributions that counter the results of our theory is that most people believed that when short selling costs are low, you can increase short selling costs a bit to prevent manipulation, but still preserve informed trading. Okay, so but the idea is because like manipulation comes from uninformed short sellers. And so the expected profit that these guys have from manipulation is lower than those speculators that actually have negative information about the firm because they're bad informed. So the idea is that because the profit from negatively informed short sellers is higher, you can perhaps increase the short selling cost a little bit to prevent manipulation, but still preserve informed short selling. But we show is this conjecture is wrong, okay? Especially when firms have very low short selling costs. We show that there's a cost that and this cost can actually be harmful. Okay, and then we look at the effect of short selling costs when you increase short selling costs on firm investment, when firms can actually write ex-ante contracts, okay, to allow for contingent refinancing or reinvestment in the future. And we show that in this case, this contingent stage financing type of contract does induce managers to signal firm value and prevent manipulation through repurchases. Okay, so we show that there's a contract, and this contract implements through an equilibrium a good one in which managers they actually the repurchase start to signal value and prevent manipulation when short selling costs are low to moderately low, which is really when manipulation is a threat. We show that when shorting costs are moderate to moderately high, then this contract is not optimal anymore because this type of contract requires capital providers to lend more funds to the firm than the firm actually requires to invest. So which means that in order for this contract to be feasible, the firms need to be able to pledge enough income to creditors. So it's kind of, if it's not necessary to do so, then this type of contract is not optimal because some firms are financially constrained. They wouldn't be able to do so. And
may I ask a quick question?
Yes, of course.
And by increasing short selling costs, like you mean some kind of uptick rule? What do you mean by that?
Yeah. So our measure of cost is an exogenous cost. So it could come from market frictions, such as government interventions like uptick rules or something like that. So we can think about this type of interventions. They're exogenous, and that changes the cost. Yeah.
Okay, so let me complement Bruno's question. So why should we think about shorting costs differently from trading costs? So if increasing shorting costs is good for one reason, why not just increasing trading costs symmetrically? Because shorting costs is asymmetric, right? In the sense that those who are pessimists are going to pay a larger trading cost than those who are optimists.
That's a great question. So here, the thing is that in our model, in this setup here, buy-side manipulations do not occur. It's not profitable. So there's no inefficiency coming from buy side. The reason is because if you want to manipulate buying the stock, you just store prices, so you lower the firm value and expectation, so you lose money by doing so. But if you short sell, then you reduce the value, so it actually allows you to exit the position at a profit. Okay, so that's the reason. So here, what matters then here is the cost to short selling, not cost to both sides. There's an asymmetry here. So great questions. Yeah, so let me continue. So because of the interest of time, I'm not going to get into the details of the model. What I wanted to do is then to show you the dynamics and the actions, the most important actions, and how the model works. So we're going to have 4 periods here. So there's a contracting period, investment period at time 0. There are going to be 2 periods of stock trading, and then there's going to be a 3rd period of reinvestment. Okay, so essentially the firm is going to have an investment need at time 0 and a reinvestment need at time 3. Okay, so the project requires an amount of I to move forward, and the firm and the firm manager, capital provider, they can sign a contract at time 0. At time 1, the state of the world is realized, and the state here affects the value of the firm. So the value of the firm is high or low. Okay. In this case, the manager and the speculator, they observe a signal, okay, about the state of the world. Okay, so the signal can actually review if the state is low, if the state is high, or it can be a completely noisy signal. It doesn't reveal anything. And then the manager, the speculator, and the noise trader, they trade in the stock market given their signals. Okay. And then there's a second round of trading where the speculator, the manager, and the noise trader, they trade again in the stock market given the signals, their past trades, and the price prevailing in the previous period. And just to be clear here, the price here is set by a market maker that breaks even in equilibrium given the information about the overall, the aggregate of trading flow and the previous prices. And then in the end here, the capital provider at the period 3, after observing the trading period, the trading prices in period 1 and 2, can decide whether to provide more funding for reinvestment for the firm to the firm or not. Okay, if that's the case, if a contract established at time 0 already did not provide that. The project then in this case here requires a reinvestment case. So if the firm does not make this reinvestment, the value of the firm's asset is 0. And if the firms make this investment, then the value of the asset depends on the state of the economy, okay, the state of the world, which can be high or low. Now, interesting here and importantly here is that at this final period here, the manager can divert a fraction 1 minus phi of the assets. So this is the agency problem here, because even if the manager knows that the state of the world is bad, so that refinancing, reinvestment is a negative NPV investment, the manager would like to invest anyways, because the manager can divert this fraction of the asset. So this creates this agency problem here that the creditor needs to deal with. So the equilibrium concept we're going to use here is the perfect Bayesian equilibrium. We're going to focus on pure strategic equilibrium. So essentially, the equilibrium is defined as first as a contract that maximizes firm value, given the trading strategy of the speculator, the trading and reinvestment strategy of the manager, and the price setting rule of the market maker. The speculators and the manager strategies are the best responses to one another, given the price setting rule of the market maker. The price setting rule of the market maker allows the market maker to break even, given other play strategies. And beliefs are all the plays are consistent with all the strategies and derived from Bayes' rule whenever possible. Okay. All right. So this is the first proposition we have. As you see, it's a very complicated proposition, so I'm not going to get into the details of it. I'm actually going to illustrate the results in a picture coming next. All I want to say about this proposition is that this is a proposition where we characterize the equilibrium. Okay. First, we show there's existence of equilibrium. And then we characterize the type of equilibrium, the most efficient one that can prevail, given different ranges of short selling costs. And short selling costs here are captured by the C. Okay. So let me illustrate the results here, and let me try to guide you through this picture. Okay. So as you see here is a three-dimensional picture here. On the x-axis here, you see the short selling cost, which is the variable of interest here. So it's like the one we're going to do this comparative statics. On the y-axis here, we have alpha, which is the probability that the signal received by managers and the speculators is informative. So the higher the alpha, the more likely they are informed about the fundamentals of the firm. And on the Z axis here, you see the I, which is essentially the firm's investment capacity. So the first thing you can observe from this graph here is that regardless of where you are on the range of the short selling cost, as alpha goes up, okay, the investment capacity of the firm goes up. Okay, that's kind of trivial because if people are more likely to be informed, prices are more informative, and the investment capacity of the firm increases. Okay, at the same time, as alpha increases, the likelihood that the speculators are uninformed reduces, so we have less room for manipulation. So first, let's start here now when we move C at very low levels of alpha, okay, when the likelihood that the speculators are informed is very low. Okay, so when short selling costs here, we start when short selling costs here are very small, close to zero, and then we're gonna start moving to the right here, and here what happens is the following: as you increase short selling costs, okay, the profit or the manipulation profit reduces. Okay, so we're up to the point that it even becomes negative at some point. So in this case, it's no longer profitable for the short seller to manipulate. So it's not an equilibrium for the short seller to manipulate. But once the short seller does not manipulate, okay, the expected price of the stock increases because in absence of manipulation, the stock price, the efficiency and informatives improves, so the price of the stock goes up. And then it makes it attractive again for the guy to jump in. So essentially, you see there's no equilibrium here where manipulation and informed short selling coexist all the time. So what happens is that in the first period, there's going to be a reduction in informed trading because of this manipulation threat. It's a credible threat. Now, the question is whether this is going to be a positive effect, it's going to have a positive effect on investment or not. Okay? So because it reduces informed trading, it means that if the probability that informed trading is very high, okay, this cost is very high, and it offsets the benefit of reducing manipulation. But if the likelihood that the speculators are informed is very low, then the benefit of curbing manipulation offsets or outweighs the cost of reducing informed trading. So in this case here, when alpha is low, there's a benefit to actually curbing manipulation, so investment goes up. Okay, and here, when short selling costs keep increasing more, investment goes even more up, because in this case, the manipulation is not even a threat anymore. Because even in the absence of manipulation, there's no interest of the manipulator to deviate and short sell, because even in that case, it's not profitable. Then, of course, when short selling costs become too high, then it's not even profitable for the informed short seller to short sell. Okay, because the short selling costs are too high, so then the investment capacity here reduces again at the end. So essentially, this is the result of when alpha is very low. But when alpha increases, okay, when the probability that informed trading goes up, sufficiently up, then in this case, then the benefit of curbing manipulation is not enough to offset the bad consequences of actually reducing informed trading. So in this case, you see there's a drop. When you increase short selling costs and alpha is sufficiently high, there's a drop in investment here, which is kind of essentially the main counterintuitive result of this first part of the model. They're saying that increasing short selling costs when short selling costs are small can actually reduce investment rather than improve investment, boost investment. Okay? Now, then the question here is that can the manager and the capital providers sit together, okay, and make an arrangement to fight manipulators, because they know, they anticipate there's going to be manipulation? What can they do? So the literature has not looked into that. We're the first ones to look into that. That's why we have this more dynamic version of the model. And of course, one of the required conditions for this to happen is that capital providers need to commit, okay, some funds to the manager so that the manager can actually conduct some stock repurchases, especially when the managers, they don't have resources to make all the investment needed. Okay? But if you commit, if you give enough money to the manager that the manager can invest and also make and reinvest in the future, the manager will do so even when he knows or she knows that the state of the world is bad because of the agency problem. Okay? So in this case here, if you give enough money, if you commit enough money to the manager, because the manager can divert this fraction of the firm value, the manager always reinvests. So in a way, this implies that the expected value of the firm is just going to be the average value of the firm across the states, okay, which is lower than the value of the firm under manipulation, because even though we have manipulation, still there's some information coming from informed trading with manipulation, which makes the investment capacity higher, okay? So which means that in this case here, it's not enough just to commit funds. You need to make funds future reinvestment contingent on the performance of the stock price. So just committing is not enough. So the implementation requires contracts to condition reinvestment on stock prices. And how so? Well, reinvestment needs to be canceled if the expected pledgeable income, okay, that the managers can promise to capital providers is enough to cover the reinvestment cost. Otherwise, this is going to be a negative NPV investment, which reduces the possibility, the feasibility of writing such a contract. Also, this contingency implies that because investment is less likely to occur when the stock price goes down, managers are going to have incentive to pull the stock price up through repurchases, okay, when they know that this can actually improve things. So the uninformed manager is going to have incentive to signal value through repurchases in order to fight manipulation in this case. So what kind of contract we look at here? I'm not going to get into the details of this again. We're just going to say with my own words what it is. Well, the manager is going to borrow some amount at time 0 and at time 3. So at time 0 when you need to make the investment, at time 3 when you need to do the reinvestment. And this borrowing amount needs to be sufficient for the manager to invest, reinvest, and conduct stock repurchases when uninformed. Because this is when the contract wants to give the ability to the manager to conduct stock repurchases and to signal value to investors. So reinvestment occurs when the expected pledgeable income conditional on the order flows is greater than investment outlay, the reinvestment outlay, okay, which is K, and does not occur if otherwise. And repayments need to be such that the capital provides at least breaks even, okay, in expectation. So this is the type of contract we look at. Now let me give you the intuition of the equilibrium, okay? So this is the next proposition. The next proposition shows that there's an equilibrium that implements efficient investment given this type of contract. Okay, and I want to give you the intuition behind this equilibrium. Okay, so how it happens. So the equilibrium is as follows. In equilibrium here, the manager also repurchases stock when uninformed about the firm, in which case speculators are also uninformed, because in our setup here, we assume that the manager is at least as informed as speculator. For simplicity, we assume that they're equally informed, okay? So which means that in this case here, the buying, because the manager always buys when uninformed, the equilibrium that we state here, when he buys, the speculator does not manipulate. The speculator does not short sell the company's stock when uninformed. So it avoids manipulation. So in this equilibrium that we propose, that we show that exists, the buying pressure here is going to be seen as the outcome of either repurchases by the uninformed manager, okay, or informed trading by a speculator that is informed about the high state, okay? Because in this equilibrium, the speculator uninformed does not short sell, okay? So which means that when there's a buying pressure here, it is seen this equilibrium perceived as purchases by uninformed manager or informed trading by a speculator informed about the high state. Moderate order flows here in this case are going to be seen as resulting for short sales by a speculator informed about the low state, because everybody knows that in this equilibrium, the uninformed speculator does not manipulate down the stock price. So this speculator does not short sell. So moderate order flows are seen as resulting from short sales by a speculator informed about the low state. Now, do people have incentive to deviate here? Okay. Well, a manipulator here would like to deviate, okay, and short sell the stock if this can come at a profit. Okay. However, okay, the manipulated short sales by an uninformed speculator, okay, counters the buying pressure of the manager, which generates a moderate order flow. And in this equilibrium, moderate order flows are seen as coming from shorting by the informed speculator. So this drives the price to zero and reduces the chances that the speculator can manipulate and make a profit, okay? So the other question here is that does the manager have incentive to deviate? and buy and repurchase stock when negatively informed about the firm. People will believe that you might have the incentive to do so. But we also saw that in this the equilibrium, he does not have incentive to do that. Why? Because if the manager short sells the stock, if the manager repurchases the stock when negatively informed about the firm, his buy order is going to offset the sell order of the negatively informed speculator. This is going to generate a moderate order flow, and moderate order flows in this equilibrium are interpreted as coming from sales of negatively informed speculators. So this again is going to drive the price to zero, which is going to lead to lead the investment to be canceled. So there's nothing to be gained here also by the manager. So in this equilibrium here, you see that the speculators, they are uninformed, they do not have incentive to deviate and short sell, manipulate, and the manager also does not have incentive here to repurchase stock when negatively informed. So this is kind of an efficient equilibrium that we show exists. So just to illustrate very quickly here, because this contract implements the efficient investment, you see that all the problems here resulting from manipulation, they're gone. So it flattens here the investment capacity from low short selling costs until moderate short selling costs. And still, of course, when short selling costs are high, there's nothing that can be done, because in this case, not even negatively informed short sellers can profit by short selling. Now, the next question is, okay, fine. You found a contract that implements efficient investment, but when is this feasible? Because, like in this case, we have agency problems, or there's a problem of pledging income to creditors. And in this case, here, creditors need to provide more funding to the firm than the firm needs in order to make the investment, so that it allows the firm to repurchase stock. Okay, so when is this feasible? So that's the next proposition that we have here. And again, I'm not going to get into the details of this, but I will illustrate the feasibility in the next two graphs. So here, what you see is on the x-axis, you see the phi, which is the proportion of the assets that the firm can credibly pledge to investors. Okay. On the y-axis, you have the alpha, which again is the probability that the speculators and the manager are informed about the firm's fundamentals. On the z-axis here, you see is the feasibility of the contract. So the contract is feasible when this feasibility measure here is above zero, and it's not feasible when it's below zero. So you see here, zero is kind of in between the green and the yellow, so it's more or less around here. So for this upper portion here, the contract is feasible. When it's below, it's not feasible. So what is the intuition here? As you see that as you increase the amount of assets that can be pledged to creditors, the contract becomes more feasible. Okay, but this is intuitive, because if you can pledge more income to creditors, they're going to be more willing to provide extra funds to the firm to do repurchases and still at least break even in expectation. The other part here is that if you increase alpha, also the contract becomes more feasible. So the more likely that speculators and managers are to be informed about the firm, the higher is the feasibility of this type of contract. And why? Because remember here, this contract, the idea is to fight manipulation. Manipulation only comes when speculators are uninformed about the firm. Okay, so if the chance that they are uninformed goes down, okay, when this goes to the left, then this type of intervention, this repurchase needs to be done less often, so that it facilitates the provision of capital by the creditor or the capital provider to fund this type of contract. The next one is we show how this feasibility depends on the liquidity of the stock and on the volatility of the cash flows of the firm. So on the x-axis here, you see that we have this variable pi here, which is a proxy for liquidity. So the more liquid the stock, the larger are the trades of the stock. Okay, and here on the y-axis, you see the volatility of the cash flow. So it's how much likely you are to observe extremes. So high cash flow versus low cash flow. So here we see that as the liquidity of the stock increases, the contract is less likely to be feasible. And this is the case because the market is deeper. So for the repurchase done by the manager to be able to signal information, it is harder. Okay, because the market is deep, it just absorbs the repurchase quickly, so there's no signaling coming out. So it makes the contract less likely to be feasible. And if you increase the volatility of the cash flows, then the contract is actually more likely to be feasible. And why? In this case, because if the repurchase is able to signal to the market that the speculator is not negatively informed, the benefit of firm value is much higher because of this volatility. Okay, so because the increase when you signal that, the improvement in firm value is much larger. So if you improve firm value, increase the pledgeable income to creditors, which increases the feasibility of this contract. So I'm just going to conclude here. Our analysis then innovates in two main dimensions here. It explicit accounts and presents a fully fledged analysis of the effect of short selling cost on manipulation and corporate policies, such as investment and repurchases. Okay, so it also shows how the dynamic or the financial contracting here allows the parties to kind of try to overcome the inefficiency of short selling. Okay, and this induces managers to do repurchase and to signal value to investors. The relation between short selling costs and investment is non-monotonic when firms cannot contract ex ante to do repurchase, or when contracting ex ante is not feasible. So it's a non-monotonic, which is kind of very important for empiricists and regulators in order to come up with interventions. If contracting is feasible, our prediction is that investment is decreasing shorting costs. So in this case, increasing short costs only makes things more inefficient, because in this case, the parties already can get around the problem. So there's no need to intervene. So if you intervene, you just reduce the price efficiency. And we show that this type of contracting is more likely to be feasible when companies have more liquid stocks, higher cash flow uncertainty, high probability of facing formed speculators, and when there's less severe manager creditor agency problems, so that the firm can commit more income to creditors. That's it.
Thank you, Rafael. So we shall open very quickly for questions. I think we have some time for that, 8 minutes exactly. If you have any question, just unmute yourself and ask. I think it's easier like this. If not, I'm still puzzled by the upward price manipulation, because it seems to me that it's by assumption that it's not profitable, right? Or I understand that, obviously, when you think about manipulation in stock prices and in this literature, is the downward movement that you're worried about. But for instance, in Bitcoin, which obviously your model wouldn't fit very well, it's essentially upward movements that you have manipulation. There's this paper by the Booth guy who was looking at the Pakistan stock market, and essentially there all the stock manipulation was upward, not downward. So I'm a little bit puzzled by that.
No, it's all right. Actually, the two types of manipulation: buy side manipulation, and short side manipulation. The buy side manipulation can come when you buy the stock, you're able to increase the value of the stock, which is not the case in our model. If you buy the stock here, you just distort information, reduce the price informativeness, which reduces the value of the company. So it reduces the profit of buy side manipulation.
Yeah, but that's a property of the model, right? That's by assumption. It is a property. Okay. So you're abstracting away from buy side. Okay.
Yeah. No, it is a property of the model. Yeah. So the model here is that manipulation here actually reduces firm value. So that's the assumption of the model. But you can think, for instance, of manipulation that increase firm value, such as so if you buy the stock, for instance, you can increase the chance that higher human capital join the firm, for instance. Just an example here. So it means that if you buy the stock, you signal that all the companies doing well, so it's more likely to attract better, for instance, better M&A deals or better human capital. And in this case, this will actually allow for buy-side manipulation. You're right. In our case here, the setup is restricted to when short selling or when manipulation actually reduces firm value, but not increase.
Yeah. Okay, great. Any other question? No, Kai. No, Caio, you cannot do questions. No, you cannot ask them. Sorry, I think I...
Yeah, I have a question.
Please, go ahead.
And I'm just wondering if you have some sort of empirical evidence, even if it's anecdotal, on this. I know you in the motivation you said, you said some things, but do you have like a chart or something that you can see this?
Yeah, so that's a great question. So Pedro and I and Murilo, we also have an empirical version of this agenda here of this paper. But the empirical task is much harder because, as we show in the paper, this effect can be highly non-monotonic. So it's very hard to identify these things. But one thing that our model here provides a very sharp prediction is that when short selling costs they decrease, repurchases increase. Okay, because the managers have the incentive to try to fight potential manipulation. And in our paper with Murilo and Pedro, we do have that pattern very clear in the data. Okay, so that, for instance, if you look at just at the simple regression, just for controlling as much as possible, we find that repurchases are decreasing short selling costs by using several measures, yeah, so, and also when you use, for instance, reg show, which is kind of facilitate short selling, we also find the repurchases kind of increased after that. So, we're working on that, but we're not done yet because it's a much harder task than just to think abstractly.
Just occurred to me one idea that maybe it's good for the second exercise, the empirical one. Because, for example, managers, they also receive stock options in form of payments, right? Yeah. So they also have an incentive in a given point in time that the asset of the company is at a high value, right? So maybe you can take these dates that they can exchange their options for money and maybe do analysis if they also, I don't know, maybe try to manipulate the market upwards. I don't know. This is something that maybe.
Yeah, I think yeah, you're right. I think for the so as Marcelo also said, the thing about the manipulation, you need to focus also on context where manipulations that reduce firm value, or like in this case, short selling is manipulation is profitable, is more likely to be present, while the buy side manipulation is not likely to be present. And vice versa. Otherwise, one can kind of offset one another. So in the end, you don't really find anything. So this kind of very thanks for the suggestion. Yeah, so the empirical work on this type of thing here is tough. Yeah. To find evidence of manipulation is really hard. To find evidence of manipulation is kind of hard. Yeah.
Yes.
Okay, great. So Rafael, if you unshare your screen, we can allow Caio to share his.
I'll try to do that because I minimize the. Okay, so I'll share. Sorry, I'm not used to using Zoom, so. Okay, so yeah.
Okay.
Yeah.
I did it myself.
Oh, you did it yourself, great.
Yeah, Caio.
I think it coincided with me.
Thank you. Can you guys hear me?
Yeah, perfect.
Okay, so thank you for having me here today. So I was very surprised that we were participating on a prize session. I had no idea that there was this prize session. So when we looked at the program, we realized that we were there. So I'm very happy for being here. So I'm going to present today this paper, which is now entitled "Pricing Denominated Pricing of Index Options in Incomplete Markets." And before it circulated as minimum dispersion residual from measures and asset prices in incomplete markets, we decided to change the title because it reflects more the importance of what we are of the position that we are taking here, which is to work with incomplete markets, okay, with the idea of incomplete markets. So this is joint work with my fantastic PhD student and co-author, Gustavo Freire. He's really an amazing guy. Like, it was great to work with him on that. So let me quickly jump into the motivation that we have for this paper. So basically, like, the question is, can we reconcile data on option prices, like information on option prices, with like underlying asset returns distributions? The idea is, what do we observe about underlying assets? What do we observe about options? So in general, like, we observe cross sections of option prices, which are directly related to the investors' perceptions about risks, and we observe time series like of historical data of underlying asset returns. And the question that was asked, like, there is a huge literature on that one, is like, can we reconcile these two sets of information? And it's complicated, because in the middle of that, in order to put them together, you need to make some assumptions about investors' preference, because like, you're observing underlying assets returns under the physical distribution, but the option prices are given, like, imagine that you're already taking into account compensation for risk, which we could imagine is like under a risk neutral distribution, or like considering a stochastic discount factor that needs assumptions about preferences. So somehow have to take a stand on that, like, to kind of try to reconcile. So what happened? There's a huge literature on that. I'm not going to spend a lot of time on that. I'm going to tell you more or less where we contribute to that. So first, many papers around 20 years ago were working with this idea of assuming complete markets, and then they try to extract information from the options data, from the underlying returns, and somehow connect these two sets by using this assumption of complete markets or dynamically complete markets. So those papers by Yatsin Etsahalia and Andrew Lowe, Jack Worth, like Etsahalia with other co-authors, and also like Engel and Rosenberg. The idea is that they would extract a risk neutral distribution from option prices. They would extract a physical distribution from like the time series of underlying returns, and then somehow they would calculate the ratio between these two distributions to be able to talk about investors' preferences, which gives you the pricing kernel or stochastic discount factor. And they found like very puzzling results. There is a new literature that arrived from that, which is like the U-shaped pricing kernel literature, but not only that. In general, they find that this pricing kernel is not monotonically decreasing with returns, which is kind of puzzling, because if we imagine that we have risk-averse investors, in general, they are going to put more weight to negative returns, less weight to positive returns on your distribution, and that should give you a monotonic function, and they couldn't find that in general. Okay, so then there's this other literature that says, okay, let me start with assumptions of incomplete market, because you really like choosing your modeling assumption. So if you are in an incomplete market, because if you are in a complete market, there's only one risk neutral measure, one pricing kernel, and so on. If you are in an incomplete market, in general, you have an infinity of these pricing kernels and risk neutral measures, which are equivalent once you impose positivity to the pricing kernels, as long as you satisfy no arbitrage. And that's what this literature on incomplete markets has done. Like they start with the incomplete market, which kind of makes some sense. Like that's one of the motivations that we have here. So if you imagine and take a look at the S&P 500 market, option market, it's huge. Like it doesn't make much sense to have like a huge market of trillions of dollars where like you would be just like having options giving you payoffs that could be perfectly replicated with the bond and the stock. So we really imagine that there are some sources of uncertainty that are related to incompleteness that are provided by these options, like in the way you trade these options. So that's why the assumption of incompleteness looks to me very reasonable. And then this literature has worked on that. And then what's the challenge there? Once you assume incompleteness, you have a bunch of risk neutral measures, actually an infinity of them, it's like a very large set. And then you don't have a price for the option anymore. You have like an option price bounds, right? Like you have bounds for intervals of prices for each option. And then the question here is, how do I select a meaningful subset of those measures such that I can give option price bound which is informative enough and that captures the observed option prices? Because one thing is like from a theoretical point of view, you're starting with the model, you're imposing incompleteness with your model, And then you're gonna get pricing, like a pricing bounds, like for the options. And then the other question is like empirical. Can, like once I observe the option prices, when I mean the option price is an option with certain characteristics well-defined, like a certain time to maturity, a certain moneyness. So I know the payoff, so I know how to price that option given a risk neutral measure. Is it true that this price is going to be within the interval that we are providing? So there is a large literature on that as well. And we contribute to this literature. How? We come up with this method that tries to reconcile the option prices with the underlying physical return distribution. So we really observe the physical return distribution. We use the procedure to risk neutralize this distribution, which is like to choose this set of risk neutral measures I was telling you before, like which is a subset of the large, like infinite set of risk neutral measures, in a way that later we ask the questions: is it true that the option prices that we observe in the market are within our bounds or not? I mean, like, are those bounds meaningful and like reasonable? And the other thing is like the way we choose this set of risk neutral measures is important to see if we can say new things, like analyze and provide new analysis about those cross sections of option prices. That's the idea of this paper. Okay, so it's really to come up with an incomplete market, like the idea, assumption of an incomplete market, select a subset of the risk neutral measures, and this subset should be such that we can say things about the options that are going to have prices within the subset, and at the same time we want to capture as many as possible those options. Okay, so this literature has worked making different assumptions on the selection of the subset. The main contribution that we have here, different from them, is that the way we select our risk neutral measures, we can really identify each measure, the marginal investor or the specific risk neutral measure that is pricing an option that is within our bounds, which was not done before. For instance, Cochrane, Sarrequeiro, and other authors like have papers, JPE published papers 20 years ago, where they provide the bounds. The bounds are very interesting and like useful, but they don't show what are the measures that price the options. They just show like the option price is going to be within this bound. And that's the contribution. So we want to be able, to provide the family. Our family is going to be indexed by a specific parameter, which is this implied gamma that we call implied gamma, which is similar to an implied volatility. I'm going to try to motivate this implied gamma to you. And the main difference is that the implied volatility from Black-Scholes, it comes from a correction of the Black-Scholes model, which we all know is misspecified because it assumes that there is only one volatility constant for the underlying asset. And once we look at a cross-section of options, even with a fixed maturity, we know that the market corrects, like giving larger implied volatilities for options that are out of the money puts compared to in the money puts. So there is a relative expensiveness of out of the money puts, because they want to compensate for the possibility of more extreme events than the log normal distribution, which is the main assumption of Black-Scholes model suggests. Okay, so the Black-Scholes model suggests that there is only one risk neutral measure which comes from a log normal distribution for the stock price, and that's not good, because even the physical distribution of returns is leptokurtic, like has thick tails, and it's asymmetric. So the log normal distribution, which gives you like a normal returns, doesn't account for any of these characteristics, like thick tails and asymmetry. So that's why in our paper we want to really connect information from the physical distribution and this method of risk neutralizing the distribution to say things about the options, for instance, like relative expensiveness, like in terms of this cross section of options with different strikes. Okay, so that's the idea. So we summarizing, we provide a method that gives option pricing bounds, and once an option is within this bound, we extract this implied gamma parameter, which gives you what's the marginal investor, pseudo investor that's going to be pricing this option, or what is the risk neutral measure in our set that prices this option, and that's going to give you information about the economic behavior of this pseudo agent, and also about a relative expensiveness of these different options. So let me try to give you an idea with this picture here. It is not simple, that there's a lot of information here. So let me see if I can work with that. So on the left hand side, I have two pictures for which are graphs of the implied volatility on the vertical axis against moneyness on the horizontal axis. Okay, And the stars and the balls here, the circles here, they are option data. So option data on calls and puts. We can choose one of the two to work with, because the other one by put call parity is going to be very similar, the analysis. So let's look at the puts, for instance. So what I'm showing here is the implied volatilities for S&P 500 options with 60 days to maturity, okay? 60 days maturity for different moneyness. So the moneyness is the current S&P value today divided by the strike. So that means that moneyness above 1 is an out of the money put, because the S&P has a larger value than the strike. So what this pattern on the left-hand side shows in both pictures here is that there is a smirk in the implied volatility function, meaning that out of the money put options, which are here on the right-hand side, are much more expensive than in the money put options, relatively speaking. If you had the same volatility for all of them, already the Black-Scholes formula would give you that out of the money put, actually like would give you that in the money put options would be more expensive. But the point is that there is a compensation here saying that I need more volatility for out of the money puts that are very sensitive to extreme events, because like the log normal distribution doesn't capture these extreme events, and then like the compensation for the log normal distribution is to increase the volatility. So there is a smirk in the volatility, and then there are those two solid lines, blue lines, which are our price bounds. I'm going to show you how we get to this price bounds. Of course, we give prices to the options, and then we convert them to implied volatility to generate those bounds in implied volatility, because that's the way the market quotes those options. So that's just like a metric to quote the option. So everything is written in terms of implied volatility, but we have the bounds for the option prices. So what we're showing that actually like for these two different dates in time, our bounds capture the whole cross-section of options. One is harder to capture than the other one. This one on the crisis, like on the subprime crisis here, 2008. And but you know, like so I want to show you how we capture those bounds, and later, you know, like what is the difference between the implied volatilities, which are on the like first column, and the implied gammas, which are on this second column that we have here. So the second column that we have here,
Sorry, before you go for the second column, let me ask you a clarification question about the first one. You said that the second graph here in the second row, it's the fact that the prices are closer to the bound means that they are harder to price. Is that so, or is that just an implication of how heterogeneous are the expectations from the different investors?
No, that's a great question. It's not harder to price. I mean, like they could have gone away from the bound. That's what I meant, because those bounds, we're going to show that like the upper bounds, they are obtained with measures in our family that are measures for investors that are very sensitive to higher moments of the returns, of course, so which are given by the negative gammas. So it's kind of inverted with the volatility. So positive, higher implied volatility means like higher prices in our lower gammas imply higher prices, because those reciprocal measures are going to be convex functions of returns. Those guys are prudent. They are very worried about downside risk. So what I mean is that like it could have been the case that we could have not been able to reconcile the prices with just extracting information from the underlying returns, which happens sometimes because we are really selecting a subset of measures, not the whole no arbitrage measure. So thank you for asking that. So that's what I meant by difficulty. Once you are inside the bound, then everything works perfectly equally. It doesn't matter if you're in the middle of the bound or close to the boundary. Yeah, so good. Now, is it okay? Any other questions before we move to the right-hand side, which is the challenge one, like the challenging one, because it's new information, right? Like it's different. So on the right-hand side, then, like you see two very different patterns, like on the non-crisis period versus the crisis period. So let's look before the crisis period, okay? During the crisis period, I extracted what is this implied gamma, which means which specific risk different measure gives the prices to all these options with different moneyness, the same maturity, which is kind of a short maturity, which is important to us. I only show you in this presentation options with short maturity, short meaning the slot between 10 days and 60 days or so, because this is the region where like that's been shown by different researchers that there are lots of important movements in the dynamics of, for instance, S&P, also the individual stocks, for jumps in the prices, jumps in the volatility of this prices. So there's a lot of, the jumps are very important for short maturity options. So, and then that's the most challenging data to capture with the bonds. And here I showed that, like, basically more or less the same investor or the same risk neutral measure with a gamma, let's say around -3 here, would be able to price all those options during the crisis. That means that if I imagine that I have a bunch of risk neutral measures, and I'm going to show you that I'm going to map those risk neutral measures in different pseudo investors with different economic characteristics, which could be risk aversion and prudence, absolute prudence. We're showing that this more or less the same investor would be giving you the prices for all these different options. What kind of investor is this guy? He's a prudent investor, because the gamma, which is this parameter that indexes our measures, is smaller than 1. For gammas bigger than 1, positive 1, the agent is not prudent. That means he's not very worried about downside risk. But for gamma smaller than 1, he's worried, he or she. And if it's very negative, it's highly worried. So this investor is highly worried about kurtosis and skewness of the returns, or like a negative extreme returns for the S&P. And we showed that basically more or less the same investor prices all the options, while in the left-hand side, you have the misspecification of the Black-Scholes model. So that means you need as some schizophrenic measure with different volatilities, while you needed just one volatility, because there's you're specifying different log normal distributions to price the different options. While we say, well, one investor can price all of them during the crisis, because all the investors, the different pseudo investors, they become prudent during the crisis. Outside the crisis, you look at this picture here with the implied gamma on the upper right side, then you see that there is a different pattern, like there are different gammas depending on the option moneyness region. And in particular for in the money puts or out of the money calls, which is this left side region, you see that the options are relatively cheap, or if you want to think about the investors non-prudent, like the gammas are very large positive. So that means this guy is not worried at all about extreme negative events. So we could think about this guy. It's very difficult to identify what this guy wants to do exactly, but we interpret them as being like investors interested in betting in large positive moves of the market, like a kind of like optimistic investors. But that's not a perfect explanation, because these guys don't need to be optimistic, because our family doesn't capture explicitly pessimism versus optimism. So it's clear that for negative gammas, the guys are prudent. So these guys are non-prudent. Okay, so but the game is very different if you're pricing an out of the money call, or if you're pricing an out of the money put. If you're pricing out of the money put, you're very worried about negative events. And out of the money call, you're not worried about those negative events. That makes some sense. During the crisis, these guys here, they become prudent as well. So Marcelo, you want to ask a question?
Yeah, I have a couple of questions actually. So can I cast that into market segmentation, in the sense that there's no segmentation in the fourth plot, whereas in the second one there is segmentation? Okay. And second, would that, instead of optimism or pessimism, could they say just lottery, preference for lottery?
You could. That I think maybe is the most elegant way, and we can rephrase that in our paper. We don't talk much about optimism. We emphasize a lot the downside side of it, but that's perfectly true. And also the segmentation is perfect the way we are looking at that. So we suggested this idea of market segmentation, which is like there are different investors pricing that have different demands, like depending on the kind of the moneyness, right? Like while during the crisis, all of them kind of become the same. They are all worried about downside risk. Yeah. So you see that this is a very good picture to explain our work. You know, like while Black-Scholes has like something misspecified, because we are assuming an incomplete market, we are able to accommodate different measures or different investors and allow for this idea of segmentation in the market. And that's what we analyze later in more details with the time series of these gamma patterns and so on. Okay. So given this introduction, I want to give you the roadmap for this presentation. I'm going to introduce the methodology first, and the methodology is split in two main parts. First, how do we identify this set of risk neutral measures that we are providing, because we are choosing the set? That's an ad hoc choice. Okay. And then later, how do we map this set of risk neutral measures to the option price bounds, right? Because we have to map, we have the risk neutral measures, then we construct the option price bounds for each option. And what do I mean by for each option specified as a function of the main characteristics of an option? What are the main characteristics of the option? The strike price, the time to maturity, and the underlying asset, of course. So you need the underlying asset because we're going to use the physical distribution of the underlying assets. That's why you need to know the underlying asset. And then the other two elements that you need to perfectly specify an option such that we can give a bound is the strike price and the time to maturity. So given the strike price, time to maturity, and one underlying asset, we show you how to construct the bound because we chose that family of risk neutral measures. So that's what I want to show you in these two bullets here. And then the third thing is like, once I showed you the set of risk neutral measures, the option price bound, suppose the option price lies within the bound, then I show you exactly which measure prices that option and what are the main economic implications or characteristics of the pseudo investor that would have that measure as its marginal utility, as his marginal utility or her marginal utility. That's the whole theory of the paper. And then in the second part, I give you like this comprehensive empirical analysis of
Sorry, is it only me or is it mute for the others as well?
It's mute for me as well.
Okay. Can you unmute your laptop, perhaps?
Still mute for me.
Huh? You can hear me,
Oh, yeah.
right?
Yes, now we can hear.
Great.
Yeah, there is something strange with my phone, so I changed it to LTE. So let's see, because I could unmute the laptop, but I think that the phone works better. Sorry about that. So then the second part is about the empirical analysis. You know, like we have 2 million S&P 500, almost 2 million prices distributed a long time for 25 years, and actually 35 years since like 1986 up to now. To 2019, and then we identified the bounds for each category of options because we know like you don't want to look at the individual options, but we're separating main big picture categories like in the money, out of the money, at the money for puts and calls, and short maturity, intermediary maturity, long maturity. And once we identify the bounds for those options, we see how many of them are going to be within the bounds, which the empirical question was telling you before, like. We select our measures and we want to know how good they are in terms of capturing the prices, and we show that they capture more than 95% of the prices of S&P 500 options. And then after that, we are able to identify the gamma implied for each of these categories, and we talk a little bit about market segmentation, or like the behavior of these different investors across the different maturities and time to maturity of the option. So that's the design of the presentation. Okay, so how do we select our measures? As I was telling you, the set of all measures that is compatible with no arbitrage is too large, so you have to reduce it. Some people have used, for instance, like the set of all measures that are compatible with risk-averse investors. That means like a second-order stochastic dominance. Okay, that's good. That gives you very good bounds. The bounds are a bit larger than ours, but you can't really identify the measures. It's just like a kind of what I was telling you about Cochran-Sahekage, another way of like a non-parametrically identifying the bounds, but not the measures. So we use this family of Crest-Reed discrepancies to measure the distance between the physical distribution of the underlying returns and the risk-neutral distribution that we want to create, because we assume that the idea, we want to start with the simple premise that there is no reason for the risk-neutral distribution to deviate from the physical distribution other than pricing the underlying asset or pricing the assets that you want to price for it to be a risk-neutral measure. If the physical distribution is already a risk-neutral measure, it prices, for instance, S&P, you don't need to change anything. That's a risk-neutral measure. But the thing is, like in general, there is some risk premium You can't really perfectly price S&P. If you calculate the expected return of excess returns of S&P data with the physical distribution, and then you can discuss how you identify the physical distribution. But one very simple way is just using empirical distributions, 1/T, like for all the observations that you have. Then you're not going to be able to get like a zero risk premium. Then you have to switch some of these weights to an equivalent measure such that you get zero risk premium. That's the idea of like a risk neutral measure. There are like an infinity, like a large infinite of that. And then even with the family that we select, which is the discrete family, where the discrepancy is a convex function of this change of measure, which I'm defining as dq dp or Radon-Nikodym, or like the relation between the physical probability and risk neutral probability. You're distorting it with this gamma parameter. So it's like dq dp to the gamma plus 1 minus 1 divided by this product of gammas here. And that is a very rich family. It captures sensitivity to higher moments of the risk neutral distribution, different moments, like a variance, like any higher moment, like a lower moment, any combination entropy. So I've used that with another co-author, René Garcia, for 15 years. And it's very interesting for many different applications. What is the advantage of it here, of this family here? First, you needed like the loss functions to identify the risk neutral measure to be convex, because like then you can use convex analysis and look at the dual problem, solve the prime problem that I'm going to pose now, which is how to identify the measure in the dual space that is going to have an interpretation of a utility function. So that means that we can give some economic meaning to the solutions for each of these loss functions in this family. And that's true for any convex function. If you start with any convex loss function, you're going to look at the dual problem. It's going to be a convex conjugate minus like the convex conjugate of the original function. That gives you a flavor of a utility function. But again, if you assume any convex function, then this family is too large. You can't say much about things. So we selected a family whose dual problem, I'm going to show you, that is like solving a higher utility problem. So that's the idea. So then we can really like this gamma parameter, which originally I showed you, I suggested that that tells you about the sensitivity of your problem in the primal space, or like how I select the risk neutral measure with respect to higher moments of the risk neutral measure. You can always also look at from the dual point of view. It's going to give you the sensitivity of the choice of this pseudo investor maximizing this higher utility with respect to returns, to values of this return, the distribution of returns, like higher moments of returns, extreme returns, like, so that's the idea. And this gamma indexes two very important economic properties: absolute risk aversion and absolute prudence. Okay, so all the members in this HARA family, they are risk-averse investors, because as I was telling you, this family is a subset of the stochastic dominance set, which is compatible with all risk-averse investors. So it's a subset, and they are all prudent, but the prudence changes according to the gamma. So both change, like a gamma, absolute risk aversion and prudence. But for all gammas on the real line, which is like the index for this parameter, the investors are risk averse. They are more risk averse if the gamma is higher. So for large positive gammas, the investors are more risk averse. But for prudence, it's more interesting, and that's the one that we really concentrate our analysis on, because it changes the sign when gamma is equal to 1. If I'm solving this problem here with gamma equal to 1, I'm finding the risk neutral measure that minimizes the variance in the space of risk neutral measures. And that's going to be a linear function of the returns. We're going to show that's a linear function of the returns. So that risk neutral measure, it's obtained. If you look at the dual problem here, the dual problem is going to be a quadratic utility problem. So that means that a pseudo investor is not worried about skewness kurtosis of the returns. So he has neutral prudence. So that solution for gamma equal to 1. For gammas larger than 1, the investors are going to have negative prudence. So they're not worried about extreme negative returns. And for gammas smaller than 1, especially for negative gammas, they are very prudent. They are really worried about negative returns. So that's the way we kind of characterize the segmentation that Marcelo asked before in terms of prudence. Okay, we don't concentrate on risk aversion because risk aversion is not the important characteristic here, but prudence makes a big difference in terms of this segmentation. Okay, and then later in the paper we show in details, like there's a lot of theory in the paper how to change from the primal to the dual problem. You know, like the only thing I wanted to pose here is like, what is the primal problem that we have? Well, we want from all the measures pi q that do what? The price, the excess return of the underlying. So that characterizes it as a risk neutral measure. That have like a mean one, which is like that means it's a probability, and that bigger or equal to 0, which is the condition to be a probability. This is a generalized probability measure. Okay, why do we do that? Because in this space of risk neutral measures, depending on the loss fund, this is not a closed space. This is not a closed space. So you need to close the space with those measures that are going to be on the boundary of the space, which have zeros on them. So like Hansen and Jagannathan, they solved their like famous like bounds for like a variance of stochastic sum factors. They already showed that this space is not closed. So to have a closed space where your optimization is well defined, you need to consider measures that have zeros. But in the paper, we like separate our analysis showing how you can identify measures that are strictly positive and how you can allow for measures that have zeros, which are basically measures that have positive gamma to the right-hand side of the family. Negative gammas, by construction, the solutions are always going to be positive, or you can't solve the problem. There are pricing errors, and then you stop selecting your measures. So that's the idea. We want to minimize those different convex losses in the Questerite family, and then we solve this dual problem. And with this, the first order condition of this dual problem, we obtain our risk neutral measures. So they are going to be hyperbolic functions of the S&P 500 return. I mean, like here, excess return with respect to a risk-free rate, right? Because we don't need to price the risk-free rate because this is a probability measure. So you just like normalize it to be a 1, like to have average 1. And then like according to this structure as a function of the gamma, we can look at the shape of this measure and kind of like extract information about it. So suppose in this example here, I have the physical probabilities or like the empirical probabilities, which are 1/t for t equal to 1 million observations. Okay, so those are the physical probabilities, 1 multiplied by 10 to the minus 6. Now, suppose I solve one of those problems. For instance, like the simplest one is the quadratic utility one, or like the one that minimizes the variance, like Hansen Jagannathan did. That gives you what is the measure as a function of different returns on the horizontal axis. So negative returns, they're going to be compensated, and you're going to change the physical probabilities to have larger probability for negative returns, lower probability for positive returns, which that's exactly the risk averse characteristic of this investor that solves the dual problem. Now, how much weight you're going to put to this negative versus positive return depends on the curvature of the measure, which is measured by this gamma. If you have positive gammas, I was telling you that the investor is non-prudent. So the investor starts giving less importance to the negative events. And that appears here, for instance, if I show you what's the measure for gamma equal to 2 or for gamma equal to 3, you see that you still put more weight on negative returns because you're risk averse, but like you put less weight than a linear guy, than the guy that solves the quadratic utility that's not worried about skewness equatory. So those investors, they are non-prudent investors. They have like a negative absolute prudence, and they are more worried about intermediary returns. If you take a look here, since there is 1 million returns, it's hard to see, but you see that that's where they put more weight than the linear, than the purple line. Okay, so that's the region where these guys with concave risk control measures are going to be more worried. And of course, for positive returns, they're not worried at all. So they put very low weight. And those measures with positive gammas are on the closure of the set or on the boundary. That's why you can start having more and more zeros here. So in our procedure, we show how to stop on the measure when you get the first zero. So that then you separate in two analyses, like the strictly risk, like risk arbitrage free, or like a arbitrage free with this like a possibility of having zeros in the measures. And on the other hand, like if you start looking at measures that are on the left-hand side of gamma equal to 1, then those measures are convex functions of the returns. So they start putting more and more weight to the negative returns, and they also put more weight to the positive returns in comparison to the linear one. So they're worried about extreme returns in general, and the difference can be like brutal here in terms of like how much weight they can put on negative returns if they are highly prudent. So that's the idea. And for out of the money puts, we show that in general, you're going to find very prudent investors pricing those puts. They are really worried and sensitive to negative events, which is compatible with this crashophobia, the characteristics of the market, which trades this out of the money puts. Okay, so in the paper, what do? We propose to restrict the big set of risk neutral measures to only look at those risk neutral measures in the Crasovide family. We show that this set is connect in the paper. We show that it's connect actually, so you don't need to worry about having different regions for the gamma separate with holes in the real line. Once you can start from gamma equal to 0, and you go to each of the sides, using the first order condition, some smart math tricks there, and then you find the two measures that define the end of the interval. After that, to the left-hand side, you start having pricing errors. To the right-hand side, you start having zeros on your measure. So then it's an endogenous set, like the gamma bar, low bar, and up bar, that is determined by the underlying return distribution, the physical underlying return distribution. Give me the physical return distribution, I identify the sets for you. And after that, we show how to, from this set, to obtain the option price bounds, right? So that's the idea. In the paper, there are more details about how to identify the set. What I'm telling you is that basically you can use this first order condition of the dual problem to identify the set. So now, how do I identify the option price bounds? As I told you, give me the option, which is the strike price and the time to maturity. We are considering that the underlying is the S&P 500, so the fixed underlying. Then I get the physical distribution of the returns of S&P, get the physical distribution of the risk-free rate, and based on this physical distribution, I identify each risk neutral measure, as I was telling you, by the strict, the first order condition. And after that, I price the option with those characteristics by doing what? By just calculating, the expected value, like the sample expected value, with each of the risk neutral measures that are indexed by the gamma for this payoff, the discounted payoff, exactly like we do in a finance theory once you get a risk neutral measure, but we have multiple risk neutral measures. With that, you can get the maximum and the minimum price. In the paper, we show that the price is monotonically decreasing with gamma. So the prudent guys that have negative gammas give larger prices because those measures are convex. The more convex the measure is, the larger is the option price for any option, calls or puts or anything. So then that means that we could identify the price bound directly by just looking at the two measures on the extremes. But we are not interested in doing only that because, as I told you before, we want to characterize the measures. Once we look at the price in the market, we want to invert the gamma to show what kind of investor is pricing that measure. Okay, so that's the idea. Then we obtain this price interval, and here I can show you, for instance, suppose I have an option with 1 month maturity, and it's at the money option, so I'm giving you the strike and the maturity. So we can do a grid for the gammas. Suppose we observe that the physical distribution of S&P, and with that we extract what are the measures, and now we are using the previous formula to price the options for a grid of these gammas between the minimum gamma and maximum gamma. You see that the option price is monotonically decreasing, and we can get the maximum price and the minimum price. Later we can just invert for implied volatility. That's what I showed you in the first picture, so inverted for implied volatility. And this didn't use any option data, only data on the underlying returns and the option characteristics. Now, if you look at some option data, you have the true price of the option. You can just invert this function because it's monotonous, right? And monotonically. Then you can invert it, and then you get the implied gamma exactly like we do with the implied volatility. So that's a beautiful result. And once we have that, we can analyze, the segmentation in this market. So that's how it works. Okay. So given that, and given that I have, I don't know, less than 5 minutes now, I'm go to the empirical analysis. So we have 2 million options that I told you before, separated in different categories, the big picture categories: in the money, at the money, out of the money. Of course, this is for puts, okay? For calls, we invert out of the money calls, at the money, and in the money calls. And you have short term, which is options between 20 and 90 days, median between 90 and 108, and long, between 6 months and 1 year. And all those options, they present this volatility as marked, saying that the out of the money puts are more expensive than the at the money in the money. And for each day, we estimate the conditional physical distribution of S&P, and we show details in the paper how to do that. Okay, the conditional physical distribution. And from this physical distribution, we identify the endogenous set of measures for each day. And then for each option, give me the characteristic. I can give you the option bound. And if the price is within the bound, I can give you the implied gamma. That's how it works. If the price is not within the bound, I can't say anything about that option. Just like I'm not able to price that option with my family. But you're gonna see that, like for all the different categories, for most of them, we price more than 97% of the options from these 2 million options, except for in the money options, short maturity, which are highly illiquid. Okay, so you see that we price 88% of puts and 94% of calls for short maturity in the money. They are not liquid. Also with dominant, stochastic dominance, they don't price everything, meaning that there might be some liquidity problems there, which is fine and it's okay. So that's for the period between 96 and 2019 from option metrics data that we use here, okay? Then later we identified the implied gamma for each of these regions. And what I want to mention here is that if you look at this out of the money region, which is the third line here of this table for puts, out of the money puts, you see that the investors are prudent, which is compatible with what I was telling you. They're worried about extreme negative movements in the market, okay, in general. And if you look at the in the money puts, they are non-prudent. The gammas are very large positive. They are not worried about negative returns. And then we have two pictures here, which are highly complex. I think I'm gonna analyze one and the other one we jump because to have some time for questions. But on the lower, on the second line here, we have implied volatilities, as we all know. So the larger the implied volatility, the larger is the option. And you see that, let me analyze for the puts here. Out of the money puts, which are in blue here, they have larger implied volatility than at the money puts, which have larger implied volatility than in the money puts, showing that there is this smirk in the market, which out of the money puts should be more relatively speaking expensive than the others. And of course, implied volatility increases during crisis. For instance, the subprime crisis or the Asian crisis here, it increases. In the upper picture, we have, and for each point of this picture, we show a moving average with 2 months within that category. And we are only concentrating on short maturity here because the others are less interesting, okay? But in the paper, everything is there. So if you go to the upper picture here, you have the implied gamma. So what can you extract from here? Many things, but I can tell you a little bit. That there is market segmentation because the in the money put is priced by guys that are non-prudent, very large gammas, and the prices are lower. And out of the money puts are in general priced by guys that are prudent. So there is a lot of segmentation, and this segmentation decreases during crisis. For instance, the subprime crisis, this shaded region here is NBR recession. So not always perfectly a crisis, but you see that in general, the segmentation decreases. And take a look at the Asian crisis here, which is not an NBR crisis, segmentation decreases so much that there is an inversion. And actually the out of the money put becomes cheaper than the in the money put. And nobody has ever shown that before because all the results observed in the literature are based directly on analyzing a risk neutral measure, which is log normal. People don't use the physical distribution. And here the power of this method is that we're combining the physical distribution with the risk neutralization that we do. And the physical distribution is already leptokurtic and asymmetric. And once you do that, you change the relative pricing of these options. So with this paper, we wanted to show two main things: that there might be some market segmentation in the option pricing market, or like a different investors pricing or demanding different regions of the moneyness, and that you can really have a different analysis in terms of the way the relative expensiveness of options once you consider the physical distribution. Okay, then we have an analysis for the crash, what happens in the crash, which is very interesting, but we won't spend time here because on the interest of time, I'm going to conclude. So what we do in this paper, we basically use this, provide under the assumption of an incomplete market, a set of risk neutral measures that we select, and we show that this set is very sensible because it shows you directly structural economic characteristics of the measures that are within the set that could be useful to price the options, and it prices most of the options of the S&P 500 options, which was one of the most liquid markets in the world. Of course, you can't guarantee that for all markets it's going to be like that, but it's a good beginning. So that's it. Thank you very much. And I think I spoke a lot.
So shall we open for questions from the public? So let me ask a question, very quickly. One, two things, like sometimes, as you said, oh, there's a question here by Alex Luis Ferreira. Curiosity, could you have imposed another theoretical structure rather than the hierarchy function? For example, in addition to a prudence and precautionary change in preferences, driving the stochastic discount factor and thus contingent claims, option prices, could you have also imposed, for example, a habit function thought of as a cyclical time series rather than individual cross-section, changing the risk aversion coefficient?
That's a great question. Actually, yeah, I thought about that during many years with René before this work. And you can impose any structure. So it depends on the way you're willing to deal with this problem. If you want to go fully non-parametric or semi-parametric like we did here, you start with the loss function family, and then it maps in an interesting family of utility functions. So you can do that, or you can start directly solving the utility function problems and assuming that you are in an incomplete market, and then you solve the utility function. The only thing that you don't have this nice property of saying, if I am in an incomplete market, then there are infinite risk neutral measures. What I'm doing is basically identifying a subset of those measures. You're going to be kind of like being a bit more ad hoc, saying, I'm going to solve utilities that have a habit formation or have other characteristics or kinks or disappointment aversion. The other thing that you can do, you can really try to map the other way around. Start with a family of utilities that you think it's interesting on the dual space, and try to map on loss functions to see what kind of loss functions you would get on the primal space, and then that would be a way of rationalizing the family that you would choose. That's an interesting question. It's just it's hard. It's hard to do what you're suggesting. Yeah, Marcelo, you were asking.
Okay, so I don't think I have so much time. I can keep that question for Gustavo's Viva. I think it would be better like this. It's 12:01, so I think we should close the session, and perhaps I will stay with Bernardo's and have a nice chat with him over tea while you guys move to the next section. Thank you very much, everyone, for coming. Bernardo, if you want to say something.
No, just to congratulate both authors. I think the papers are amazing, and indeed they should be on this session. So yeah, now continue here. Thanks, everyone.
Thanks very much,
okay, guys.
Yeah.
Thank you. Bye-bye.
Bye.
Thank you.
Bye.